Hello and welcome to the latest episode of Wright's Insights. I'm Angela Wright of Wright Wealth Management, and I am here to help you make sense of the markets and the election. This is, I think, an anxiety-ridden day for many of us. This election seems to feel really different, and I want to give you something else to think about. A lot of candidates are out there, the two, are out there saying that if you vote for the other person, it's going to destroy your 401k. And I want to help you understand the reality behind all of that. First, a note from my lawyers. Everything that I say is for educational purposes only. Please do not act on anything without talking to your own advisor. And of course, all past performance is not a guarantee of future results. If you've been with me for a while now, you know I like to give the whole story away right in the beginning. I can't sit around waiting for somebody to deliver the answer to me at the end of a presentation. So here's what you really need to know. First, it is extremely difficult to identify any systematic pattern of market returns in election years. On average, markets have been positive in both election years and the subsequent year. This is a good one. Market expectations associated with election outcomes are already embedded in security prices. I mean, if you take nothing else away from this presentation, that third point there is helpful for all of your investing activity. By the time Joe Investor receives information, it is already baked into the stock price. Why and how? Well, hedge funds, for example, get that info and trade on it so much more quickly than you can. So like by the time it's on CNN, it's either been expected by other investors or other folks have just traded out ahead of you. Unless, of course, you have insider info, in which case you should never trade on that. Getting back to the election and the markets. If you ever attended a statistics class, you might recognize the bell curve here. What we're looking at is US presidential elections since 1926 and historical monthly performance data. The red lines are a month in which a Republican was elected president, and the blue lines are a month in which the Democrat was elected president, and the gray lines are every other month we have available for data. So what do you notice about this chart? If you're scratching your head thinking, nothing, you're right. There is no discernible pattern in the month of the election, whether a Democrat or a Republican was elected. But you have all of these people who make trading decisions just based on the fact that an election is happening. I know somebody that trades out usually around October and then comes back in before the end of the year, simply because they believe, wrongly, that that it's going to be negative during the election year. And you see a totally standard bell curve here. It doesn't matter that it's an election month. So how about after? What you're looking at here is every presidential race we've had since 1928 and the S&P 500 returns. The S&P is the 500 largest United States stocks. The average return during an election year is represented by the blue line, that is 11.57%, and subsequent to the election, the green line, 10.67%. And it doesn't seem to matter here who was elected. Those are the average returns that we've seen since 1928. How about during the entire presidential term, right? People will say to me, but Angela, they haven't had any opportunity to enact all of those policies that they were campaigning on. Can't they enact tax law or corporate policies? Can't they impact, monetary policy? We should see that reflected, right? And you also have a lot of people believing that Democrats are good for people and Republicans are good for money. This old adage, but look at this. You see really no pattern between Democratic and Republican presidential returns. The average return since 1929 is 9.5%. Now, my Democrats might look at this chart and say, no, hold on. The only negative returns were Republicans. This data shows reinvestment of all dividends throughout these years. If you pull that back and don't reinvest the dividends, there are some years where the Democrats post a negative return. And so just a quick lesson on data and statistics. it really matters how you slice and dice data, and you can make data say almost anything. So I invite you to put your discernment hat on when you're looking at a piece of data and question it truly and really understand what you're looking at, because it might not be as it seems. So how about bonds, right? The S&P 500 is not the only investment that we have available to us. Do political parties have an impact on bond returns? I've got data here from 1976 forward, and you can see all the presidential races. And again, what we're looking at here is the year of the election and the year subsequent. So again, bond returns are by and large positive, 7.3% during the election year and 6.8% after the election year, regardless of who won that election. Let's take a look at annualized returns during the president's term. And again, we're looking at bonds from 1977 today. And again, no real pattern, whether we have a Democrat or a Republican in office. Our average bond return has been 5.7% since 1977. I want to just pull back and look at the markets historically across all of the different presidential terms. Red represents, of course, a Republican president, blue is a Democrat, and what you're looking at is how $1 invested in 1926 would grow to today. And what you can see here is you have a little over $10,000. But if that adage that Democrats are good for people and Republicans are good for finance is true, wouldn't we see a very serious pattern of blue going like this every time Democrats took over? We sure would, but we don't, because it's not true. And excuse me, patient investors who have stuck it out regardless of who the president is have won in the long run. So all of that posturing about, on the campaign trail, I'm going to be good for this person's going to destroy your 401k and I'm going to make sure everybody in the country is rich. No, the president is not like a puppet master on that. It's about corporate profits. And that's something we really need to keep in mind. But Angela, you say, the president might not be a puppet master, but Congress is. Doesn't it matter who controls Congress? Doesn't it stand to reason that if Republicans control Congress, the market outlook will be better, because it stands to reason that lower corporate tax rates, lower taxes on people, would incite more spending, therefore more corporate profits? Turns out, nope, it doesn't matter who controls Congress either. Republican, Democrat, or mixed, we generally see upward trends across all political parties. Are you getting bored with the same message over and over yet? I really want to drive this point home. So today, as you're freaking out about the election, it's not going to matter so much on your pocketbook. Of course, this is a very important election for many, many reasons, but you can sort of take your investments out of the conversation. As optimistic as I am about the long-term outlook for markets, I know it's really challenging to keep that historical perspective in mind when we're inundated with campaign advertisements and news alerts and experts analyzing the latest polls and the candidates themselves telling you that the other person will destroy your life. There's a lot of noise out there. What's important in politics and investing is being able to separate the meaningful information from the noise. One of my favorite words is discernment. Do you have your discernment hat on when you're watching the news? Do you have your discernment hat on when you're talking to your neighbor, when you're watching this presentation, right? So, everybody out there is saying that the other person's going to destroy the markets, but history shows us that the markets have moved forward regardless of who led the polls and who won the elections. When people feel uncertain, they might be tempted to make investment decisions based on how they think the election's going to unfold, but there's nothing in that historical data that's strong enough to warrant changing your investment allocation based on who you think might win. And in fact, trying to time the market often leads to costly mistakes. Investors are generally better off looking beyond the election and maintaining their steady approach to markets. So control what you can control. If you're feeling anxious about your investments, talk with your financial advisor. Look at your plan, stress test your plan, understand what different market conditions mean for you, and then allow them to back up and show you the historical perspective that it really isn't going to matter. I'm not sure which presidential candidate will prevail, which party will control the Senate or the House, but my 23 years in finance have taught me to believe in the power of markets. And if you look at what's happened in just the time I have been an advisor, markets adapted to Y2K, 9/11, a global financial crisis, an interest rate crisis, a fiscal cliff, a war, and a pandemic, multiple wars actually. Despite all of this uncertainty, $1 invested in the S&P 500 stocks in January of 1999 would have been worth more than $6 at the end of 2023. And when we look back 25 years from now, I'm fully confident the markets will have continued to work and that investors will still have a positive investment experience. So, today I'll be watching the returns just like everyone else, but I won't be adjusting my investment plan. And when I need to, I'm going to turn off the TV and go out for a walk to take care of my mental health. As David Booth, the CEO of Dimensional Funds, often tells people, vote with your ballot, not your life savings. I hope you have a wonderful day. Take good care.